The market is officially closed right now, so we are looking at the final numbers from the most recent trading session. Nvidia stock wrapped up the day at $205.19 per share, marking a slight intraday increase of 0.16%. It was a relatively quiet, grinding session, with the stock bouncing between an intraday low of 203.44 and a high of 207.07. Anchored heavily by a massive trading volume that reached over 112 million shares by the closing bell. Now, when you see a stock hovering around a $5 trillion valuation, you expect every minor uptick to be driven by the usual talking points, like expanding data center demand or cloud hyperscalers ordering more hardware. But what the market completely missed in this specific session is an incredibly quiet, highly strategic maneuver happening across the Pacific. Nvidia just started telling its Chinese clients that its brand new Vera central processing units, chips engineered to handle general-purpose computing tasks alongside intense artificial intelligence workloads, could be shipped as early as this August. In fact, a major Chinese cloud provider has already quietly stepped up to order more than 300 of these Vera-based servers just for early testing. This creates a massive curiosity loop for anyone looking at the ticker today. The common ground among most casual retail investors is that Nvidia has completely lost its footing in China due to aggressive Washington export curbs and Beijing pushing local tech firms toward domestic chip suppliers like Huawei. The prevailing narrative says that Nvidia's market share there has dropped next to zero, meaning the region is a dead growth engine. But the deeper reality is that Jensen Huang is playing a much more sophisticated game. By shifting the battlefield from standard graphic processing units to these next-generation central processing units, Nvidia is trying to bypass traditional roadblocks and find a backdoor into the world's second-largest economy. If this Vera chip testing goes smoothly, it could trigger a wave of unexpected infrastructure spending that Wall Street analysts haven't even modeled yet. To really understand why the stock is consolidating at $205.19, you have to look closely at the intense tug-of-war playing out in the daily swings and weekly trading volume. Just a couple of weeks ago, the stock was trading significantly higher, pressing hard against its 52-week high of 236.54. Then the entire semiconductor sector experienced a brutal wave of institutional profit-taking that wiped out billions in market value across multiple tech giants in a matter of days. This recent volatility has completely altered how big money is handling Nvidia stock. If you open up the Robinhood stock trading app or look at institutional block trades on the Interactive Brokers platform, you can see that the frantic retail buying of early spring has cooled down into a highly calculated accumulation phase by major funds. The daily trading volumes, which frequently surged past 160 million shares during the peak of the recent pullback, have started stabilizing. Institutional investors are using this consolidation window to reassess their asset allocations, moving cash away from speculative tech bets and parking it firmly into high-conviction megacaps. You can see this shift happening across major platforms. Whether individuals are executing self-investing strategies through a standard individual brokerage account or letting an automated robo-advisor manage the rest via Schwab Intelligent Portfolios, the focus has shifted entirely to structural sustainability rather than short-term hype. People are actively seeking professional investment help to figure out if this price level represents a safe floor or a temporary ledge before another leg down. This brings us directly to the fascinating tension between expectation and reality regarding Nvidia's capital allocation strategy. The general expectation for any business growing its top-line revenue at a blistering 85% year-over-year rate is that it will hoard every single dollar of free cash flow. Wall Street logic says that hyper-growth tech companies should reinvest all their capital back into research, development, and supply chain commitments, because that cash compounds far faster internally than it ever could in the hands of a retail shareholder. Mature, slow-growing legacy companies return cash because they have officially run out of big ideas. Yet Nvidia completely shattered this paradigm. Alongside its latest financial disclosure, the board authorized a massive, eye-popping $80 billion share repurchase program, alongside a staggering 25-fold increase in its quarterly dividend, bumping it up to 25 cents per share. The market is completely torn on how to interpret this move. Is it a sign of peak maturity, suggesting that the explosive build-out phase of global data centers is reaching a plateau? Or is it a historic demonstration of absolute financial dominance? When you look at the raw underlying data, the reality leans heavily toward dominance. Nvidia generated an unbelievable $96.7 billion in free cash flow over the recent fiscal year, with a single quarter alone printing nearly $49 billion. Chief Financial Officer Colette Kress explicitly stated that returning at least half of this cash to investors is not a one-time gimmick, but a core, long-term operational target. When a company can aggressively fund its next 3 generations of silicon architecture while simultaneously handing tens of billions back to shareholders, it forces everyone from casual retail traders on the SoFi Invest platform to veteran portfolio managers at Fidelity to completely rethink how they value a high-growth tech stock. Let's pause right here, because I want to hear your thoughts on this balance of power. Go ahead and comment below how many shares of Nvidia stock you currently hold in your portfolio right now, and let me know if you are actively buying more at this 205 level or waiting for a deeper drop. When you strip away the daily market noise and look at what this business actually does, you realize that Nvidia's true moat isn't just the physical silicon chips it designs, it is the deeply entrenched ecosystem it has built around them. For years, the core business model relied on selling high-end graphic cards to PC gamers and video production studios. That legacy business provided the financial baseline, but the real pivot happened when the company realized that the parallel processing architecture of a graphics card was perfectly suited for complex mathematical calculations and neural network training. This led to the creation of CUDA, a proprietary software platform that allows developers to program NVIDIA hardware directly. This software layer is the real secret behind their near monopoly. A massive cloud provider cannot simply swap out NVIDIA hardware for a cheaper competitor's chip because their entire software stack, thousands of developer tools, and countless AI models are built specifically to run on CUDA. Over the past several years, this ecosystem has expanded into what management calls the AI Cloud Infrastructure and Enterprises segment. Instead of just selling components, NVIDIA now builds entire national AI factories and massive integrated data center architectures. They provide the chips, the networking switchboards, the cooling blueprints, and the software operating systems. This past performance history shows a company that has successfully transformed itself from a component vendor into the foundational infrastructure provider of the modern computing age. Looking forward, the trajectory of NVIDIA stock will be decided by how reality matches up against some incredibly high expectations over the next 12 to 18 months. The primary near-term catalyst is the official production ramp of their new Vera Rubin platform, which is scheduled to hit the market in the third quarter of this year. If this rollout goes off without a single hitch, it will likely cement their competitive advantage and keep their operating margins at historic highs. There is also a massive opportunity brewing in the rise of agentic computing workloads, where software systems operate autonomously to solve complex corporate tasks, requiring continuous round-the-clock computational power. However, the risks are equally massive. If the capital expenditures of major cloud hyperscalers begin to normalize, or if tech giants find meaningful success developing their own in-house custom silicon chips to save on costs, NVIDIA could face sudden margin compression. To wrap everything up, our analysis of NVIDIA shows a company caught squarely between a cautious market narrative and stellar fundamental execution. While the broader public assumes the stock is taking a breather due to geopolitical friction in China and industry-wide cooling, the reality is that NVIDIA is quietly opening up new product lines like the Vera CPU, protecting its margins and returning historic amounts of cash to its investors via an unprecedented buyback program. The tension between what the market expects and what the company is actually delivering is creating a unique setup. Whether you are managing your own holdings on self-investing sites, utilizing automated tools like Schwab Intelligent Portfolios, or executing precise options trades through interactive brokers, understanding this underlying structural strength is what separates emotional trading from true institutional-grade analysis. NVIDIA remains the central pillar of global tech infrastructure, and its ability to continuously defy traditional corporate growth models is exactly what keeps it anchored at a historic $5 trillion valuation. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. /backs. Don't forget to like, comment, and share this video to support the channel.